So Friday comes and that new paycheck rolls in. So you finally have money for those new shoes you've been looking at, maybe that new watch. But treat yourself to a nice dinner. And then of course you have to pay your bills and your rent and insurance. And the next thing you know, all that money's gone and you're waiting for the next paycheck to roll around. And you might watch Mark Tilbury and think you're financially savvy, but most likely you're just ignoring those bills. But don't worry, in this video, I'm gonna give you a 4-step process to show you exactly what to do after your paycheck hits. And most people making these videos are telling you to budget 10% of your income from this charity or that charity, when the reality is that 40% of adults don't even have enough savings to cover a $400 expense. So until you get yourself on your feet, Red Cross is gonna have to wait. Now, step number 1, subscribing to this YouTube channel, because I'm dropping some of the best finance videos on credit cards, banks, and budgeting every single week. Just kidding, but if you want to, it really helps the channel out. So step number 1 is to find your financial baseline. And what this means is find exactly how much money you have to spend every single month to survive. And no, this doesn't include your emergency pizza fund. This is the bare bone necessity that you need just to survive. So this is gonna be things like housing, food, your transportation, utilities, and everything else you need just to survive. Now, to make things more simple and easy to understand, I'm gonna use Joe as our poster boy. Joe's a 30-year-old electrician making $50,000 a year. So people's baseline is usually 50% of what they're making. And if that's not the case for you, you might want to revisit how much money you're spending on rent or your car payments or how much money you're making. Anyways, our boy Joe's bringing in about $4,000 a month. This means his financial baseline is right around $2,000, which leads us on to step 1.5, and that's creating an emergency fund. Now, I know what you're thinking. You already have a stable job and you have a couple hundred in savings and you don't need a huge emergency fund. But this is the same way I thought a couple years ago. And when my finances got a little bit rough, I had to sell some of my stocks at the bottom of the market and I took a big hit, which I could have avoided if I just had a couple of $1,000s in my savings account. So in the savings account, you're going to want 3 months saved up of your financial baseline. So because our boy Joe needs $2,000 a month to survive, he's going to want to save up $6,000. And what he's going to do is put that in a high yield savings account. Now, most savings accounts usually give you less than 1%, but you can go and open up a high yield savings account for free online that'll give you upwards of 5%. I made a separate video on all the best high yield savings account right now, and I'll link that in the top of the comments. But when you put your money in a high yield savings account, it's going to outpace inflation and make you a tiny bit of money too. So now that you got a little bit of money saved up and you can finally breathe, that's going to lead us on to step 2. And step 2 might be the most important part, and that's don't invest any money yet. If you have any high interest debt, you have to pay that off immediately, because any savings account, stocks, funds, or even crypto coins aren't going to be able to earn more money than you're going to be losing if you have high interest debt. The average American has $7,000 in credit card debt with an interest rate of 24%. So if our boy Joe has $7,000 in credit card debt, he's going to end up paying over $700 in a single year. And a lot of people are just making the minimum payment on their credit card, and that keeps their account in good standing and keeps their credit score up, but it'll take years to pay off your credit card if you're just making the minimum payment. But that's okay, because there's a couple different options when it comes to paying off your credit cards. So the first is just making more than that minimum payment. I know it can be hard, especially if you have other debts and other things you need to pay for, but if you don't do this, you're just going to end up paying thousands of dollars in interest over the years. You can also do a balance transfer to another credit card. So if you have good enough credit, you can get another credit card that comes with a 0 balance transfer period. Transfer your money that you're paying the credit card interest on to this 0 balance transfer card, and then pay it off before the 0 balance transfer period is over, so that you're just paying on the amount you owe and you're not paying all this money in interest. Another option is to get a debt consolidation loan. The way this works is you take out a loan that has a lot lower interest rate than you're paying on your credit card. You can get one from usually 6 to 10%, so you're paying a lower interest rate than you would with your credit card. You can also negotiate with creditors. If you owe a lot to the credit card companies, a lot of times if you call them up, they'll work with you and give you a lower interest rate or a lower amount of money to pay on. And the last thing you want to do is avoid taking on new debt. And you have to be super careful with the debt consolidation loan or a 0 balance transfer credit card, because you don't want to open up another line of credit that you're just getting more debt on. But most likely our boy Joe doesn't just have credit card debt. The average household debt in the United States is over $90,000. This includes mortgages, student loans, auto loans, and credit cards. And there's 2 methods that you can use to pay off this debt. First is the snowball method. With the snowball method, you're going to pay off your lowest amount of debts first. So you'll start with the credit card or the loan that you owe the least amount of balance on, and then knock those up one by one until you get to the highest balances. Now, technically, this isn't the most financially optimal way to go about it, but it's more of a psychological thing, because when you're in debt, it can weigh over your head and it can feel impossible to pay off all these different balances. So when you use the snowball method, you're knocking out these accounts and you can begin to see that it's actually possible to crawl out of debt. Now, with the avalanche method, you continue to make the minimum payment on all your accounts that you owe money on so that they stay in good balance while paying off the highest interest account first. So let's say Joe has an auto loan that with 12% interest, personal loan with 15% interest, and then credit card debt with 20% interest. He's going to start at that credit card debt, pay it all off in full, and then move down to the personal loan and then the auto loan. And this way makes the most sense because you're going to be paying the least amount of interest long term. Now, step 1.5 and 2 are pretty much interchangeable, and it just depends on your personal preferences and tolerance to risk. So you can create that emergency fund first because it's going to offer you more security, and then if something big does come up, you have money to pull from, and you're not going to have to take out another loan and go into even more debt. But if you want to pay on your high interest debt first, then you can probably save a lot more money in interest because you'll be paying off this debt for a shorter amount of time. But after you knock out those first 3 steps, we can then move on to step 3. And just hold on with me for a little bit longer, because after this, we're going to start getting into the fun stuff. So now that we're out of debt, we have some money saved up, and we know how much money we have to spend every single month, we can then create a budget. And I know this seems boring, but it's one of the most important things you can do for your financial health. If you don't have a budget, then you're going to be bleeding money. You're going to be losing money here and there for random stuff you don't even care about. At first, it seems like a budget's constricting and it's not going to allow you to have as much fun, but a budget's actually going to free more money up so that you can spend money on the things that you actually care about. And if you follow a budget, you're already going to be ahead of 70% of Americans financially, because only 1 in 3 Americans actually budgets. And now more than ever, it's even easier. You can download a free app like EveryDollar that makes it super easy to track all your spending. Or if you want to go old school, you can use an Excel spreadsheet. I'll leave a link below if you want to use that. So the general budgeting rule is that you should spend 50% of your income on your basic necessities. If you follow the first step, you'll already know. 30% for wants and then 20% for savings. Now, I can tell you right now that most Americans don't follow that 20% for savings because the average American only saves 3.4% of their income. So just to start out, we're going to aim for 10% of your income saved. And saving can mean investing too. This is just money you're setting apart for the future. So because Joe's making $4,000 a month, he's going to be saving $400 of that. And step 4 is when it starts to get really fun. This is when we can finally start investing our money and having our money work for us instead of our money working for other people. And there's 3 different types of ways you can invest your money. The first is a 401k. This is an account offered by your employer, and usually they'll match 3% of whatever you put in. So these accounts are tax deferred, meaning you're not going to pay any tax on them until after you pull it out of the account. Also, you're not going to want to pull these funds out of your account until you retire, because if you pull the money out before you turn 59 and a half, you're going to have to pay a 10% early withdrawal fee. Now, after you get the maximum match from your employer, you can then invest in a Roth IRA. Now, a Roth IRA is one of the best investments out there, and that's because you're going to be taxed before you put your money in, meaning that all your money is going to be growing tax-free. Now, this is also a retirement account, so just plan to have the money in there until you're 59 and a half, because if you pull it out early, then you're going to get charged a penalty. And then the third is a traditional brokerage account like Robinhood. With this account, you're going to be able to pick your own stocks or index funds and invest in whatever you choose. The only disadvantages of this is there's no tax benefits like there are with an IRA or a 401k, and also you can pull out the money whenever you want. But just make sure you're holding stocks for at least a year, because if you pull them out before a year, you're going to be charged capital gains tax, which, trust me, is going to be a lot higher than you're going to want to pay. So because Joe's saving $400 a month, let's take half of that and put it into the stock market. Over the last 10 years, the stock market's paid an average of 12.58%, but we'll be conservative here and just say it's 10%. So if Joe's putting $200 in the stock market, after just 10 years, he'll have $41,229, and that's just in his brokerage account. Now we can move on to step 5, which is automating everything. You've probably heard of the book by James Clear called Atomic Habits. And one of the main ideas in this book is no matter how good something is for you, you're not going to keep doing it unless it's easy. So we're going to work on reducing as much friction as possible and automate things so your good financial habits can stick. So whenever your paycheck hits, you want to automatically have the money go out. This way you don't even notice it leaving your account, and you don't have to manually go in and transfer funds to your 401k and your Roth IRA and all these different accounts. Only weird financial freaks like me actually enjoy doing that. So make sure all your bills are paid automatically. You automatically have money going into your savings account, and if you use credit cards, all of them are paid off on time. And if you have credit cards, set up automatic payments. So if you made it this far, you know exactly how much money you have to spend every month. You've created your emergency fund in a high yield savings account. You've paid off all your high interest debt. You're creating and following a budget. You have money being invested for your future, and all of this is happening automatically, so you don't even realize the money's leaving your account. And really quickly, I want to give you 3 tips to help you before you leave. Number 1 is have all your bills on the same schedule. The best way to do this is put all your payments for credit cards, for insurance, or utilities all on the same day. The easiest days are the first of the month or a couple of days after you get paid. Another tip is pretty much everything is negotiable in finance. That includes when bill payments are due. So a lot of times credit card companies or landlords will tell you that they can't move your due date, but if you tell them how much you need them to do it, and if you remind them of how good of a customer you've been in the past, 9 times out of 10 they're going to give you what you want. And the last tip, which is something that I already covered, but I just want to stress this one more time, is make sure you set up automatic payments for all your bills. This is the number 1 way to stay financially healthy, and also the number 1 way to ruin your finances. If you found any value in this video, make sure you like and subscribe, and let me know what you guys think in the comments, because I reply to every single one of your comments.